Welcome back to Bank and Balance, your go-to place for understanding the world of finance and investment. If you're new here, make sure you hit that subscribe button, so you never miss out on any valuable insights. Whether you're new to investing or already experienced, we're here to help you navigate through the often confusing world of finance, offering practical advice for building a solid portfolio and making smart investment choices. Today, we're tackling a topic that should be on every investor's radar: how to find financially stable stocks to invest in for 2025. The goal of investing is to generate wealth over time, but the key is finding stocks that not only show strong potential today but also have solid foundations that can lead them to succeed in the long run. It's about choosing companies that are resilient, have a competitive edge, and have a proven track record of weathering both good and bad economic cycles. When you think of investing, think of it like planting a tree. You don't just want to plant a tree in any patch of soil. You want to choose the right soil, the right tree, and care for it so it can grow over time. The same applies to investing in stocks. You need to pick companies with the right foundation and then watch them grow over time, making sure you're aware of what to look for. Now, before we dive into specific stock recommendations for 2025, let's talk about some basic financial metrics that should guide your investment decisions. These are the numbers that tell you whether a company is healthy, whether it has room to grow, and whether it's positioned to succeed. These metrics are simple but powerful, and understanding them will help you identify the right stocks to add to your portfolio. Let's start with revenue. This is the total amount of money a company earns from selling its products or services. Think of it like the income a business generates before it pays for anything, like rent, salaries, or the cost of raw materials. If a company has steadily increasing revenue year after year, it's a good sign that the business is growing and its products or services are in demand. For example, a company that makes and sells software might have strong and growing revenue if its products are becoming more popular and more customers are willing to pay for them. Next, we have profit margin. This is the percentage of revenue that a company keeps as profit after all its expenses are deducted. Imagine a bakery making $10,000 in a month from selling cakes. After paying for ingredients, rent, and employee wages, if the bakery is left with $2,000, that means the profit margin is 20%. A company with a high profit margin is typically more efficient at turning sales into profits, and this indicates strong financial health. In general, the higher the profit margin, the better, as it shows the company is able to manage its costs and generate good returns from its operations. Another crucial metric to look at is free cash flow. This represents the cash a company generates from its operations after it has spent money on things like equipment, buildings, or research and development. Free cash flow is essential because it shows how much money the company has left over to pay off debts, reinvest in itself, or distribute to shareholders in the form of dividends. A company with strong and consistent free cash flow is in a good position to weather financial storms and continue to grow. It gives the company the flexibility to make decisions without having to rely heavily on borrowing money. The debt-to-equity ratio is another important factor. This metric compares the amount of debt a company has to its shareholder equity, the money invested in the company by its owners. A low debt-to-equity ratio means the company is less reliant on borrowing money to fund its operations, which can make it more financially stable. Conversely, a high ratio might indicate the company is taking on too much debt, which could be risky, especially if economic conditions take a downturn. Now that we have a better understanding of these important financial metrics, let's look at 5 companies that have shown consistent growth, stability, and potential for the future. These are companies that not only perform well today but have strong foundations that position them for success in 2025 and beyond. First on the list is Microsoft. Microsoft is a tech giant that has proven itself time and time again, and its financials are as solid as they come. In 2023, Microsoft generated $211.9 billion in revenue, and its profit margin sits at a strong 36%. That means the company is efficient at turning sales into profit. Microsoft also has a free cash flow of $56.4 billion, which gives it the flexibility to continue investing in growth or return money to its shareholders. What's more, Microsoft's debt-to-equity ratio is 0.4, meaning the company doesn't rely heavily on debt, making it financially stable. With its dominance in cloud computing through Azure and its growing role in artificial intelligence, Microsoft is positioned to continue thriving in the coming years. Next, we have Alphabet, the parent company of Google. Alphabet generated a huge $290 billion in revenue in 2023, and it boasts a profit margin of 25%. This indicates that Alphabet is very good at turning its sales into profits. The company's free cash flow sits at $63 billion, which is an impressive amount that shows Alphabet has ample resources to continue expanding and investing in new technologies like artificial intelligence and self-driving cars. Alphabet's debt-to-equity ratio is extremely low at 0.1, making it one of the safest options for long-term investors looking for stability. Then there's Tesla, the electric vehicle leader. Tesla is a bit more volatile compared to companies like Microsoft or Alphabet, but it's a stock to watch for 2025. Tesla's revenue hit $87.7 billion in 2023, and the company has a profit margin of 14.6%, which is still impressive for a high-growth company. Tesla also has $5.7 billion in free cash flow, which gives it enough money to continue investing in its future, including new models and energy technologies. Although Tesla's debt-to-equity ratio is higher at 0.8, this is typical for high-growth companies that are rapidly expanding. As the world continues to embrace electric vehicles, Tesla is poised for continued growth. Another stock to consider is Apple. Apple continues to dominate the tech world with its ecosystem of devices, software, and services. In 2023, the company generated $394 billion in revenue, and its profit margin sits at 25%, showing its ability to turn sales into profits. Apple's free cash flow is enormous, with over $100 billion available to reinvest into the business or return to shareholders. Although Apple's debt-to-equity ratio is higher at 1.5, the company has one of the largest cash reserves in the world, which makes it well equipped to manage its debt and continue innovating in the future. With continued growth in wearables, services, and possibly augmented reality, Apple is a strong pick for 2025. Lastly, we have Johnson & Johnson, a leader in healthcare and consumer goods. This company is less volatile compared to tech stocks, making it a solid choice for risk-averse investors. In 2023, J&J generated $98.5 billion in revenue with a profit margin of 19.2%. The company's free cash flow stands at $22 billion, which gives it plenty of resources to invest in research, new drugs, medical devices, and acquisitions. With an aging population and increasing healthcare demands, J&J is well positioned for growth in the coming years, making it a great long-term investment for those looking for stability and consistent returns. When choosing stocks for 2025, it's crucial to focus on companies with healthy financials. Look for solid revenue growth, strong profit margins, good free cash flow, and manageable debt levels. Companies like Microsoft, Alphabet, Tesla, Apple, and Johnson & Johnson offer a solid mix of growth, stability, and financial strength, making them great picks for the future. By paying attention to these metrics and picking stocks that are financially sound, you can build a portfolio that's primed for long-term success. If you found this video helpful, don't forget to hit the like button, subscribe to Bank and Balance, and click the notification bell to stay up to date with all our latest videos. Thanks for watching, and happy investing.